Well, good morning, everyone. It's a great pleasure to be here. This is only my second trip to Oslo, and for both occasions, it was to come to discuss very important issues. The first time I came 3 years ago was to launch an initiative involving a whole-of-government approach to fighting financial crimes, tax crimes, and other illicit flows. And today we're here to talk about tax avoidance and specifically the work of the OECD and the G20 to deal with these issues. This is an agenda that the OECD has had for quite some time, but our efforts have been substantially stepped up in the last 2 years. And I'm going to explain to you what we have been doing and why. And at the end, I hope we can have a very fruitful discussion and debate about the issues that are being addressed and further issues that need to be addressed. And so I'm going to talk about this project called BEPS, and it has been very much in the news, but I know that not everyone knows and understands what this strange acronym means: base erosion and profit shifting. And what we're talking about is tax base erosion and profit shifting. And I think this illustrates probably in the clearest way what it is we're talking about. Many times you will hear in the news that we're carrying out a fundamental reform of the international tax rules. And this is fundamental, but we're not trying to encompass everything in this very ambitious 2-year project. What we're talking about is situations where, through tax planning strategies, you have economic activities occurring in one place, whether it's manufacturing, R&D, sales, but the profits from those economic activities are all ending up in another place, and usually in another place that has little or no taxation. And these kinds of arrangements are, like it or not, for the most part legal. And what they do is they basically exploit differences between national tax systems that produce unintended, undesirable results from the perspective of tax administrations, and also they come about as a result of the way the international tax rules connect or don't connect. And so why are we talking about these issues now? Because I'm sure for many of you, these kinds of situations are not new. And for us, they were also not new, but there has been a lot that has changed since the international tax rules were first developed. We now have changing business models. If you think back to the 1990s, what was the business model that most multinationals used? Well, basically what they were doing was that they had very highly centralized, country-specific approaches to their activities, and so they would have within a single country all aspects of their product development chain. Whereas now in today's economy, you have something that looks more like this: highly decentralized activities. We have global value chains, and frankly, global value chains are very good because they ensure that the productive activity is spread throughout the world. But what you see here is you have all the different parts of the development of products or economic activity disaggregated and spread out through many different countries, and then you have a central control, and a central control where you have the central risk-taking. Now, the other thing that has changed over time is the rise in the importance of intangibles and services in terms of producing profits, as opposed to the old days when you had manufacturing as your main source of productive activity. And the thing about intangibles and services is that these can be moved very, very quickly. So as a result of this changing business environment and the key fact that we now have a digital economy, we now have a very different situation in terms of how businesses interact. If you think back to the old retail models, can you really compare a Main Street retailer with an online retailer. A Main Street retailer has a direct connection with its customer, a direct physical connection with the community and the government that is taxing those activities. But now, in an online retailing scenario, you don't have that physical connection. You don't necessarily have a physical connection with your customer. You don't have a physical presence necessarily in the country where you are offering your goods, and often you don't even have a physical product that you are selling. And so this is a very different environment. And yet our tax rules, which were designed for a manufacturing economy basically, where you had physical connections, physical products, physical activity, maybe are no longer suitable for this kind of environment. Well, for those of you who are tax experts, and I realize there may not be that many in the room, but many of our tax rules are in fact based on a physical presence, and we now have this situation. So I think one of the key reasons that we're talking about these issues right now is that there is a recognition that in this changing environment with changing ways that businesses do business and the changing nature of the economic activity itself and the development of globalization and the internet economy, our international standards are a bit outdated. These international standards were the core of them. Obviously, we have been updating them over time, but the core of these standards were actually developed over 100 years ago, and not even by the OECD, but a precursor, the League of Nations. And those initial rules have been the foundation of the standards that we originally developed primarily to try and eliminate tax barriers to cross-border trade and investment. If you think back after the war, what was it that countries were trying to do? They were trying to restore growth, rebuild Europe, and so one of the issues that they focused on was this idea of trying to remove all barriers, and tax can be a barrier to cross-border trade and investment. And so there was initially the development of a model income tax convention to prevent double taxation. Now, even back then, we had provisions to prevent tax avoidance and evasion. And that was mainly focused on information sharing. But the focus and emphasis was not really on that activity, but really focused on eliminating double taxation. And so here you have the two key instruments from the OECD that try to do that. You have the Model Tax Convention, which now forms the basis of over 3,000 bilateral tax treaties, and then we have the transfer pricing guidelines that we developed, which help countries to decide on how to allocate income among the different parts of a multinational enterprise. Now, this explains why we're looking at this now, but why has it had so much focus? Well, in part, it has had so much focus because of the efforts of organizations such as Publish What You Pay. The role of NGOs and the media in highlighting these issues, in particular after the economic crisis, has been quite influential in moving this debate forward. Because if you think about it, what happened after the crisis? Governments were faced, most governments were faced with very difficult choices. On the one hand, they had to try and spur growth. And on the other, they needed revenues because with the downturn, they had less of the normal tax revenues than they had. So in many cases, what did governments do? Well, first, they tried to lower corporate taxes to try and spur growth and increase job creation. At the same time, as I said, because they needed revenues, they often ended up increasing VAT, property taxes, and personal income taxes. And so you had this imbalance, if you will, where you had the ordinary citizen being asked to pay more, and at the same time, corporate stated tax rates were going down, and in addition, you had these kinds of headlines showing that even if the corporate tax rate was, 20 whatever, corporations in many cases were paying, as was shown in the video, 1 to 2% of corporate income tax. And so this issue of fairness in the tax system became and has become a very important issue in the public debate. I don't think we've ever had so much focus on taxation in the media, on the streets, and in parliaments. There have been many countries that have had parliamentary hearings to talk about the issue of tax avoidance by multinationals. So the focus from so many different areas, from government's perspectives, from the public's perspective, and now from the politicians' perspectives. In 2012, the G20 made this issue of tax-based erosion and profit shifting a key issue and asked the OECD to report on how to address this issue of tax avoidance. And as you see here, that was when we started. They asked us to develop an action plan, and as Mona just said, in last month we delivered to the G20 leaders a report setting out what we had done to address these issues in our action plan. Now, our action plan has 15 specific actions to try to address these issues. But I wanted to just highlight, before we get to that, this is the key paragraph of the communique that was issued last week by G20 leaders. And you can see that the first sentence is focused on the fairness of the international tax system. Now, why is this so important to them? Well, fairness is important in the tax system to ensure compliance by all taxpayers, because if taxpayers feel that the system is unfair, then compliance will go down. And so this is very important from a tax perspective, but even wider than that, if you get citizens to accept that their system is fair and they're willing to comply more, this has spillover effects in the overall confidence in the government in general. And so that is why, for political leaders, getting the tax system right is so critical. Now, turning to our action plan, as I said, we have this 15-point action plan to address the base erosion and profit shifting issue. And what we're really trying to do there is we're trying to establish coherence in the corporate taxation context. And we're trying to restore the connection between where profits are taxed with where the substantive activities to generate those profits are occurring. In addition to that, we are trying to increase the transparency related to corporate taxation so as to improve certainty and predictability, both for governments and business. And I think it's important here to highlight that what we're talking about, as I said, are generally things that are legal under the current tax rules. And so for us, this is not an anti-business project. We are trying to fix the rules which are broken and allow this to happen. And in order to do this, we do really need to work with countries to do this together, because no single country can really effectively address these issues on its own. Why? Because, let's face it, there is the reality of competition between countries to attract business investment and to maintain business investment in their home country. So if one country goes out and establishes very strict rules to counter tax avoidance, that business activity and those jobs will shift to another country. And so that's why we need to have this concerted effort to bring everyone together to address these issues. Now, in addition to the coherence, substance, and transparency, we also are targeting work on the digital economy. As I said, I think this was one of the key drivers of the focus on this issue, and it was also one of the key areas of attention in the wider public. And so we did prepare a report on the digital economy. How is it different, and what does that mean for the international tax rules? In addition to that, we also decided that we needed a new way of trying to implement change once we agreed. And so we decided to look at, would it be feasible to develop a multilateral instrument to amend those 3,000 bilateral tax treaties? Because if we come up with agreements to change the rules to stop these tax avoidance activities, but then it takes years to renegotiate all of these treaties, well, what have we really accomplished? And so we carried out a study to look at whether or not this would be feasible. It's rather innovative. Now here you have the 15 actions, not in numerical order, but under these basic headings of coherence, substance, and transparency. And I can briefly describe some of these, but I don't want to get into too much detail because technical tax can be incredibly boring sometimes. But just to kind of hit the high notes here, hybrid mismatch arrangements, what are those? Well, they can be very complicated tax structures, but essentially what these structures are designed to do is to take advantage of differences in national tax laws in how they treat certain transactions. And so what these can produce is 2 deductions for a single payment, or a deduction in one country and no inclusion of that income in the other country, the other side of the transaction, which means there's a double benefit. And one of the simplest examples of this is where something is treated as an interest payment in one country, and so there's a deduction there, and then in the other country, this is treated as the receipt of a tax-exempt dividend, and so there's no inclusion there. So this is one of the issues that we are trying to address, and this was one of the first deliverables that we produced in September of this year. Then we're also, and this is related, the issue of interest deductions. Interest deductions are one of the easiest ways to shift profits from a high tax jurisdiction to a low tax jurisdiction, because by paying interest or creating artificially the payment of interest, you can get a deduction in the high tax country to reduce your taxes, and then at the same time it's treated as income in the low tax country, and so there you have your income not being taxed or being taxed at a very low rate. CFC rules, what are these? Control of foreign company rules. These are designed, it's an actual anti-avoidance rule in the sense that what it tries to do is income that normally would be allowed to be taxed in another country is brought back into the home country's tax base where it meets certain criteria, and low tax can be one of the factors that is looked at in that context. Harmful tax practices. This goes back to a project that we started in the late 1990s, looking at tax havens, looking at preferential regimes that are designed to attract activities. And what we wanted to be sure of in that context is where you're attracting activities through the use of a lower tax rate, that there's also substantial activity there and transparency, etc. And we are reinvigorating and strengthening that work through the BEPS project. Now, in terms of substance, and I'll go through these quickly, prevention of tax treaty abuse. A lot of tax treaties can be abused by persons, basically companies, and also individuals that were not intended to receive the benefits that were negotiated by 2 sovereign states. So we have now come up with a rule that basically says that all countries have to include an anti-abuse provision in their tax treaties to avoid those unintended consequences. Now, there are several aspects of our project that relate to transfer pricing, which is the allocation of income between related parties. And so that's focusing on intangibles, it's focusing on risk and capital, and it's focusing on high-risk transactions, as well as the documentation requirements for transfer pricing. We are also looking at disclosure rules, establishing mandatory disclosure of tax avoidance strategies. This is something that some countries have been doing, but now we're trying to develop an international standard so that all companies will have to report their tax avoidance strategies to tax administrations. And then finally, on the sort of transparency aspect, we are focusing on dispute resolution mechanisms. Why? Because it is important. We recognize that at this time of great change in the international tax rules, that there is a likelihood of an increase in double taxation. And so it's very important that we ensure that there isn't double taxation, because again, countries need businesses to invest and to create jobs in their countries. And if companies feel that the tax environment is too burdensome to carry out activities because of things like double taxation, then they may take their business elsewhere. So it is important to establish a dispute resolution to ensure there is a minimization of double taxation and greater certainty in outcomes. And then, as I said before, we have produced a report on the digital economy and the multilateral instrument. Now, we have very ambitious objectives in this project, in that what we're trying to do is to restore source taxation through several of these actions, restore also the residence country's taxation, and to ensure that the rules operate basically as they are intended for both residence and source country countries. Now, we have a very ambitious timeline. Some people say it's too ambitious. Certainly some of my staff members who are working night and day on this feel it's maybe a little too ambitious. But we have to do this very, very quickly. Why? Because we cannot have this current situation of great uncertainty, where the rules are changing, but businesses don't know how they're changing. Different countries who have been affected by this want to act, but they can't wait forever for the international rules to be resolved. And so we've set out a 2-year time frame for this project. As I said, we delivered the first 7 outcomes of this project in September. We are hoping to deliver the rest of the project ideally by September 2015, and if not, by the end of December 2015. And this is, I think, really, really critical to meet this deadline. We feel pretty confident, having delivered the first set of actions on time, that we will be able to deliver the remainder. But this is very, very challenging because we have taken on some very difficult issues. Now, what is it we actually produced? As I said, the digital economy report. Well, here we looked at the digital economy, and initially, and some of you may be aware that there were proposals for, oh, let's have a Google tax, or let's have special taxes for this particular type of activity. But as we worked through the digital economy, what it means, where it is present, we came to the recognition that there is no such thing as the digital economy, that you can't ring fence it. That actually, it's the whole economy. It is in every aspect of every kind of activity. I mean, even we had fascinating presentations by, I think it was Volvo and some other auto manufacturers, where they showed how much technology is built into cars, trucks, everything, so that these motor vehicles that you think are just for transportation are sending back critical economic data back to central headquarters to analyze how trucks are used, when, et cetera, et cetera. So we cannot say that the digital economy is something separate, and so we maybe don't need to develop special rules for them. That is not, however, to say that we shouldn't look at the existing rules to see how they should be adapted. And so, for example, one of the issues, one of the key principles in international taxation is the principle of having a permanent establishment in a country, which enables you to tax the activities in the country associated with that permanent establishment. And so that is based on a sort of physical presence and activity there. But of course, we now have a very different situation where, for example, we have what is called big data, and that's not physical, and where does that get taxed? We also have businesses that rely very heavily on warehousing, for example. Now, under the current rules of permanent establishments, warehouses were considered an auxiliary ancillary activity, and they were exempted. But when you think about Amazon, where warehousing is a big activity, well, maybe that rule should be reconsidered. And so those are the kinds of things that we will be exploring in the context of the other 15 action items, and then return to see whether there's anything else we really need to do for the digital economy if it's not addressed in the other actions. Then we have our report on harmful tax practices, and that report deals with issues. One of the issues that has been in the news a lot is the issue of innovation boxes or patent boxes. Now, this report is an interim report. Why? Well, for two reasons. One is we need to see at the end of the whole project how all these different pieces fit together, but also it's an interim report because we were not able to agree on one element. And so I guess in our minds, at least in September, we felt this was one of the failures in our delivery because we were not able to reach agreement among all countries about how you should determine whether substantial activities are associated with a patent box. Now, you may have seen in the news that Germany and the UK announced that they had a proposal they were bringing to the OECD that they thought would resolve this issue, and we are, as we speak, we have been discussing this with the countries participating in this work, and we hope to have good news in the near future on that. Then we had 4 instruments that I won't really go into in detail because I think I have covered most of those. I do want to go into the transfer pricing documentation and country-by-country template because obviously Publish What You Pay has a big focus on country-by-country. Now here, what we have done is we have required 3 different things. Everyone focuses on country-by-country, but we have required companies and countries to establish a master file, so a general overview of a multinational enterprise's overall activities, because as Mona said, you need the picture of what the company is doing as a whole to understand what is happening in your small part of the world. The other thing is we're requiring local filing of transaction-specific information with the tax authorities, and then country-by-country reporting on income and taxes paid and other indicators of economic activity. And that is now the template is agreed, and we're still working, again, this week on the details of who needs to file this, where, when, and how. Now, I've talked a lot about what we're doing, and I think it's important to stress the importance of this issue for developing countries. Because actually we were asked to say, why is this important for OECD? It's important for OECD, but it's frankly important for all countries. Many people have said, oh, well, developing countries have bigger issues to deal with. But if you look at these figures, you see that corporate taxation is a very important part of revenue for developing countries. In fact, corporate income tax represents a much greater percentage of the overall tax take in developing countries than in developed countries. So it is an important issue for developing countries, and we have had extensive consultations with developing countries to get their views in how we should approach these issues. And what we announced very recently is that we're going to bring in more countries into this discussion, and also to establish regional networks to have a regional dialogue about these issues. And so we did, in our first round of discussions, have regional consultations in Latin America, Asia, Africa, with French-speaking developing countries. And in addition to that, we have various topic-specific global forum meetings where we discuss transfer pricing, tax treaties, VAT, and we bring together over 100 countries to discuss these issues. But we felt we still, despite having all of these discussions, we weren't really getting enough input from the developing countries on these issues. And through this process, we also asked for their feedback. What are the issues in terms of base erosion and profit shifting that are important to them? And we identified several issues that we are now working on with the IMF, the World Bank, and other international organizations to address those issues. Things like wasteful tax incentives. Well, we didn't really put this in our action plan because we were working on this through our tax and development program, but we are now going to step up our efforts and develop toolkits on a range of issues that were identified by developing countries as being important to to their efforts to address tax base erosion and profit shifting. Now, as I said, we're doing all of this work at very high speed and very intense, but we're trying to involve all of the key actors in this process. We are also bringing in the regional tax organizations to the dialogue on these issues so that they can also help us identify the issues that are of concern in the developing countries, and also to take back the best practices from the work that we are doing to help share those practices. So it is a two-way dialogue that we are trying to establish. We're also speaking to donor agencies to help step up the amount of aid that is being devoted to tax issues. I mean, we often say, how do you spell development? It's T-A-X. We need to allow countries to gather their own domestic revenues in order to finance their own development. So that's really the BEPS project. I do want to say, since there was such an emphasis, both in Mona's comments and in the video, on transparency and the issue of tax evasion, I think it's worth highlighting some of the other work that we have been doing to increase transparency. I hope you all now know that we have basically eliminated bank secrecy through our work through the Global Forum on Transparency and Exchange of Information. First, through exchange of information on request, which allows a country to ask another for specific information in a specific case, which is very important because you can imagine in a transfer pricing case, you will need information from another country, but also now with automatic exchange of financial account information. And just yesterday, Switzerland signed the Multilateral Competent Authority Agreement to allow Switzerland to exchange this information with other countries around the world. So I think we're making dramatic progress in the transparency and information sharing front. And I hope that with these efforts, we are making a very important step forward in furthering the objectives of ensuring that all taxpayers are paying what is legally due and their fair share to their governments. Thank you very much.